Hey folks, if you've been wanting to learn how to trade stock options, you've been wondering how they work, this is the video for you. It's the ultimate primer. It's the ultimate guide to understanding how stock options work. And I'm really proud to share it with you. My name is Jeremy Whaley. I'm founder of Trade Maestro. And this is a little bit of a departure from the normal videos that we do. Normally I do about a 10, 15, 20-minute video and it's all studio produced. And what we're doing for this one is this is actually an excerpt from a live webinar that I taught tonight. And it comes from a course or an accelerator that we've been doing called the Retirement Wheel. I'll put the link to that in the comments. If you're interested in that strategy, then click on it and that might be perfect for you. But what I needed to do for that group is to give them a primer into how options work, because I had some new people who never traded options. And normally when I teach this, I take about 5 or 6 hours to teach it, but I didn't have that much time. So I just went through and I pulled out the best of the best, the most important things that people needed to know. And as I taught it tonight, I was like, man, this is really good. So I want to share it with you. I think it's the most complete introduction you'll ever get into how stock options work, from the philosophy of how they work as an insurance tool to the pricing, when calls go up, when puts go up, all these different factors. It's all here in this next 70-minute training, the most compact immersion into stock options I think you'll ever find. Let me know what you think in the comments. Just go ahead in the comments, give me your thoughts on it. And again, if you want to learn about the Retirement Wheel, I'll put that down in the comments as well. If you haven't liked and subscribed to the channel yet, please do so. It helps me. It will help you ultimately, but it really helps us with the channel as we're trying to grow stuff here. So with no further ado, I present to you the ultimate primer on understanding stock options. Let me know what you think, and I'll see you on the other side. All right, welcome everybody to the Retirement Wheel. I'm thrilled that you guys are here. Super excited to get into this. It's a fantastic strategy, and I think it's going to be a great program, and I'm looking forward to sharing it with all of you. Tonight's lesson is kind of a prerequisite. You could call it lesson 1. It's really like lesson 0, because it's the lesson that you need to go through if you've never traded options and if you need a primer for options. And so that's really what this lesson is. It's an introduction to options. And I could easily teach for about 5 or 6 hours on this topic. In fact, it is in my bigger course on how options work. I've taken most of tonight's slides from that course, and in that particular course, the content I cover spreads over 3 modules, and that's 4.5 hours. So I'm not going to cover all of that, but there is 90 slides, and I'm going to go quickly. And the reason I'm doing it is just because I want everybody to have something you can come back and reference and say, okay, there's a consolidated introduction to some of these. But I may go quickly through some examples, and if you need to ask questions, then feel free to do so. All right, so here's what you're going to learn in this lesson, not the overall retirement wheel, but just in this lesson, we're going to talk about what are stock options, what is stock options 101, kind of the basics, the essentials that you need. We're going to talk about option chains, and I'm going to give you an introduction into option pricing. As I mentioned, I do have a more complete program on options, especially introductory options. It's called Working with Stock Options. It's part of your membership at Trade Maestro, and you are welcome to go watch that. There's probably I want to say about 8 to 10 hours of training in that particular program. And we're going to go through just some high-level introductory stuff in this particular lesson. So let's answer the question first and foremost: what are stock options? What are stock options? And here's how I'm going to answer it. I'm going to start off by saying there's 2 types of options. We've got calls and we've got puts. So if you're making your notes at home, write it down. You've got calls and you've got put options. Now let's do a definition. A definition is going to look like this. First and foremost, you need to understand that options are a contractual agreement. When you buy an option, you're not buying equity. You're not buying part of a company. You are buying a contractual agreement that gives the buyer the right to do something. And in the case of a stock option, what the option does is it gives the buyer the right, but not the obligation, to buy or to sell a specific stock at a specific price on or before a specific date. Okay, now this is the definition of an option. This describes what options are, and specifically this is American style options. If you go over to Europe, or if you trade any index options here in the United States that trade European style, the definition changes just a little bit. But for American style options, it's the right but not the obligation to buy or sell a specific stock at a specific date, at a specific price on or before a specific date. Now, as I'm reading this, you could sub out a couple of terms. You could sub out the word crypto for stock. You could sub out the word futures for the word stock, and you can even do it for Forex. I don't typically teach futures and Forex and crypto options, primarily because the market for it is substantially smaller, number one. And in the case of crypto options, there's not a lot you can do right now in the United States. Now, if you're abroad, if you're watching this and you're from abroad, you can go to Binance and actually a handful of other crypto brokers or dealers, and you can actually trade crypto options, and you can do so. Most of them operate in the exact same way as stock options do. But I'm not going to get into that. I'm just going to teach you what options are in this lesson. So the question becomes, why would it matter? Why would it matter for somebody to have the right, but not the obligation to buy or sell a specific asset, in this case stock, at a specific price on or before a specific date? And to help you understand this, I'm going to go to an example, which is what I like to do. Okay, so let's take a look at this trade right here. And you can see that this stock absolutely collapsed. It was trading up around 335, 340, maybe peaked out at 350, and then boom, it's collapsed. And it did so very, very quickly. In this case, it collapsed to $225. Now, if you look at the dates, you'll notice this was the S&P 500 over COVID. Okay. Now, if you were holding SPY, if you were holding this trade over COVID, and in a 5-6 week period of time, it collapses almost 50%. What are you thinking? You are absolutely, pooping your pants. I mean, let's just call it what it is. Your pants are messed up now, and you're sitting here looking at this like, what in the world have I done? You did everything they told you to do. You held this thing, you bought it, you held it for a long time, and now it has just collapsed on you in a matter of weeks. And millions of people felt that way. But what if you could go back? What if you could go back in time and you had the opportunity to sell your stock at a higher price? How would that have changed things? What if you could go back in time and sell at a higher price after the crash? Well, instead of being freaked out, instead of soiling your pants, you'd be like, dodged a bullet for that one. What I just described to you would be a call option. The right, but not the obligation to, what I just described to you is a put option. The right, but not the obligation to sell the stock at that particular price. Okay? A put option is the right, but not the obligation to sell a specific stock at a specific price on or before a specific date. That's what you would need in this circumstance. Now, you already understand this. You already understand this idea. The idea that you've got insurance. You already do this in things like your homeowner's insurance if you own a home, or maybe you don't own a home, maybe you rent. You already do this for things like your car or any other type of insurance. If you think about your automobile insurance, you go to the dealer and you buy yourself a brand new Porsche, and you're all excited about this $120,000 sports vehicle. You worked your whole life. You're exactly 63 and a half, and you got to retire a year and a half early. And you spent some money in this great Porsche, and you call your State Farm or Allstate or Progressive agent, Geico, and you say, hey, I got this new Porsche, insure me. And they say, sure enough. And you pay your premium. Why do you do that? Because as soon as you pull off the lot, there's a little 16-year-old kid who's driving a moped, not looking at where they're going, and they drive right into you. And you just want to make sure if that happens, somebody's going to cover the risk. And what would happen if that 16-year-old hit you? You'd call your insurance agent and you'd say, you wouldn't believe it. I'm pulling off the lot and a stinking 16-year-old hit me. Got all this damage, brand new Porsche. Now, they're not going to sit there and say, that stinks, you're on your own. They're going to say, that really stinks. I hadn't even collected your premium yet. No, they're going to say, okay, no problem. Here's your deductible, $500, $1,000, whatever your deductible is. And then you go get this fixed and we'll pay the rest. And you mitigated the risk. That's what insurance is. Apply that idea to the stock market. Now, it's not exactly insurance. It works a little bit different, but the principles are the same. An investor can use a put option, the right to sell, to insure a stock investment. Just like any other insurance, it has a premium. We call it your option premium. It has a time frame. That's your expiration. And we'll call it the deductible, which is not really what it's called, but it's how it functions. It's the difference in your strike price and your current price. And so if you think about it in these terms, you realize that an option is not complicated. An option in this case, a put option is something you're already very familiar with. You use the same principle to insure your home every day, or to insure your automobile, or to insure other things in your life that you want to make sure you've offset the risk. It doesn't make you money. It just offsets the risk. That's the essence of what an option is. We call it something different, but it's the same function of insurance. So now, with that understanding, ask a different question. If a put option gives you the right to sell a stock at a higher price if the trade goes down, and if it insures a long stock position, what could a call option insure? And the answer is, you already understand this. It's just the opposite. So imagine that you are in the middle of a major market crash and you think, okay, market's been going down. It's down 50%. It's going to keep crashing. I mean, this is the big one. It's the end of the world. This thing's going to zero. So you start shorting the thing. And you short and you short and you short and you got all these open shorts. Next thing you know, you were wrong. And this thing just goes up. And now you've got an obligation. Since you shorted the market, you are required to buy to cover. And if you shorted way down here at, 230, 245, 250, and now suddenly it's trading at 320, you're sitting there in absolute shock and awe. How could this happen? By the way, do people do this all the time? Yes. They buy high, they ride it all the way down, they freak out, they sell it, and then they're like, well, let's make some more money, and they short it, and then it turns around and goes back up. I know you wouldn't do any of that because you've been my students all these years, but people do that. But what if you had the ability, what if you had the opportunity to go back in time and buy at the lower price? You could buy to cover your short stock at a lower price, even though the stock's going higher. Well, now, again, you would be relieved. You're like, wow, I dodged a bullet on that one, right? Because you have the right to buy the stock at a cheaper price. If you did that, you would use the tool, the instrument that we call a call option. It's the right but not the obligation to buy a stock at a specific price on or before a specific date. Now, as I've already said, you understand this. You understand this idea. You understand it because you get it with insurance. Insurance on a home offsets the risk. If you're living in an area and a tornado comes through and it blows your home down, it's not what you want, but you can call your insurance agent and say, my home blew away. And they're going to say, well, that really stinks, but okay, we've been insuring you for all these years. I guess we better pay you. And it's damaging, obviously. You have to start over, but at least your $500,000 home or whatever your home is, it depends on which stage of inflation you're in. Back in the day, it was a $200,000 home. Now it's a $2 million home. Your home is covered, and whatever it takes to repair it, they're going to cover that. Well, you just flip that upside down, and now it's the same with a short stock, and we just call that a call option. Like I say, you get this idea with a put option. A call option is just insurance for your short stock. It's stock insurance. That's all it is. So an investor can use a put to insure a stock investment, and they can use a call to insure a stock trade, or a short stock, I should say. We use a put to insure a long stock. We can use a call to insure a short stock. That's the essence of what stock options are. Now, that idea, that vehicle that we just called a stock option, the right but not the obligation to buy or sell a specific stock at a specific price on or before a specific date, that vehicle and the fact that it has these contractual rights going back and forth, that vehicle on its own now carries monetary value. And it opens up a world, a plethora of trading opportunities. For example, you could use this vehicle as a tool to insure your stock. That's the primary purpose of stock options. That's what they were kind of created for. But in the process, you ask the question, well, how does State Farm make money? How does Progressive make money? And the answer is they sell insurance. Well, guess what? With stock options, you can also make money selling the insurance. You can sell the premium. And as we get further into the wheel strategy, we get into the retirement wheel, you're going to learn that selling option premiums can make you a lot of money. There's a flip side of it, and that is you can buy these options, and as the price moves in the right direction, as a put goes down, as a call goes up, you can sell them as a leveraged trade. So there's a speculative opportunity that goes along with options. You can take the options and you can buy them and sell them and combine them in all sorts of different ways to create an incredible plethora of strategies. In fact, the first book of option strategies that I bought was about this thick. It was 1,100 pages, that classic Larry McMillan book. I don't know if you can find it anymore. Finally, people started doing simpler training on options. But back in the late 90s, when I was learning this stuff, that was where we started, because that's how complex the world of options can be. It doesn't have to be, but it can be that complex. That's how many opportunities are created with the world of stock options. So what we're going to do for the rest of this lesson is I'm going to get into the basics. I'm going to teach you about stock options, what I'm calling Stock Options 101. This is just the absolute basics of stock options. And by the time we're done over the next, 70 to 90 minutes, you're going to have a basic understanding of how options work. And then moving forward in this training for the retirement wheel, we're going to focus in on the selling side. We're going to focus in on what does it mean to sell options and collect premium. For others of you, you may decide that you're going to go off and do different strategies with it, and that's great too. And of course, if you want to really go deeper, then check out the longer course, the How Options Work course. All right. But as a quick primer, let's answer the question again. What is an option? Well, we've already said it. It's the right, but not the obligation to buy or sell a specific stock for a specific price on or before a specific date. I come back to this over and over again because I think everybody should have it memorized. If you memorize the definition, if you understand exactly what an option is, then you can actually break down all the other dynamics. When you get into a complex trade, you can ask yourself, did I buy it or did I sell it? What did I sell? I sold the right. Do I have an obligation? Do they have an obligation? You just think through it all. So this definition, if you're stuck on a desert island, this definition in and of itself is something that can decode what happens with the option. Okay. Now you notice I put in highlighted yellow, the right, because as I said just a few moments ago, an option is a contract. It is a contract, and that contract is the right. It carries with it the right. That's what the contract is. It's about rights. Who has the right to do what? And if you remember that, and you remember I'm not trading a stock, I'm trading a derivative, I'm trading an option that is tied to the stock, then you start to understand that it's a similar ball game. It's just a different game. Okay. So there's two types of options. I've already taught them to you, calls and puts. The call option is the right, but not the obligation to buy. So we can simply say calls are the right to buy. If you remember that, calls are the right to buy. Put options are the opposite. Puts are the right to sell. So if we can just remember, a put option is the right to sell. If I buy a put, I buy the right to sell. If I sell a put, I sell the right to sell. Now, there's two sides of the trade. There's two sides of the trade. We always have a buyer and we always have a seller. And you need to understand this. When we're trading stock, people don't think about the fact there's another side of the trade. There is. People just don't think about it. When you're trading options, you really have to think about it, because you have to realize that I could choose to be a buyer and I can open a new trade as a buyer. Or I could be a seller and I can open a new trade as a seller. One of the disconnects that happens a lot of time for new options traders is they're thinking stock. They think, well, I buy a stock and I open a new trade. I sell a stock and I close that trade. That makes sense. I buy a new house. I own it. I sell the house. I no longer own it. People get that. In the world of options, imagine that it's not just the asset that we're buying and selling, but remember, it's a contract. And when you create that contract, somebody had to create it and literally sell it to the market. And that person is known as the seller. So when we think about option selling, you are creating the open interest. A lot of times, whenever I talk about the rules for buying, I teach that you need to have a higher open interest. And then, people come over to selling and they're like, well, I don't understand. There's low open interest. Why don't you make a big deal about it? Because you're creating the open interest. When you sell a new option, you're creating the contract. You're literally creating that open interest and you're selling it to the buyer. So why would we do that? Well, the buyer is sitting over here with a wad of money. If you're selling an option, you're selling whatever it is. If you want to sell a call, you want to sell a put, you're going to sell that to the buyer. So if you sell a call option, you are selling the right to buy the stock over to the buyer. The buyer is then going to give you the cash. And you're like, ka-ching. That's why it works. I often say that in option selling, it's one of the only things that's guaranteed in the stock market because it's true. You sold the contract. You sold the contract. You're guaranteed to get the money for it because you sold it. Same thing happens for a put. If you're an option seller, you create the put option. You say, I'm going to sell somebody the right to sell me the stock. And you sell that to the buyer, and in exchange for that right, the buyer gives you the money. Now, if we put names to this, we would name the buyer client, and we would name the seller insurance agent. If you go call your insurance agents, my guy's name is Jeff. Candidly, I don't like Jeff, and I don't like the company he works for, but I've had insurance with him for almost 30 years. It's another story. But so Jeff, if Jeff wants to sell me insurance, he's going to create a policy and he's going to sell it to me. And I'm going to pay Jeff a wad of cash. In my case, I pay him every month. And I have homeowners insurance for not one, but for 2 houses. I have boat insurance. I have 2 cars insured. I have a life insurance. I got all these insurances because Jeff told me I need to have them. And so every month, around the end of the month, it happened yesterday, they go in and they take money out of my bank account and they renew that policy every month. And guess how many times I've died? I've never died. They keep getting paid every month for me to not die. I have had some other claims for other things, but never died. So I guess that's a good thing. Anyway, I digress. What happens? You guys, I'm using this metaphor because it's easy to understand. If we call the seller the insurance agent, they write a contract. They literally fabricate it out of thin air. They create it. They create it out of thin air. I don't think fabricate was the right word. They create it out of thin air, right? It didn't exist. They write it. They sell it to you. Now this contract is in existence. And since you paid them, you now have the right, if your house burns to the ground, or if your car gets hit by a 16-year-old or an 86-year-old, you can call the insurance agent and you're like, hey, you sold me the contract, dude. They're like, yeah, you're right. So understanding that, there's 4 trades that can happen to initiate a new trade. If you're the option seller, you can start a new trade by selling a call or selling a put. If you're the option buyer, you can start a new trade by buying a call or buying a put. 4 trades. And like I say, those 4 trades can be combined in all sorts of combinations. All right, moving right along. So if we look at these definitions, we can say the option is the right but not the obligation to buy, that is a call, or to sell, that is a put, a specific stock at a specific price on or before a specific date. What's happening? The seller, aka the agent, is creating the contract and literally selling those rights to the buyer. And in the process, the buyer of the option is purchasing the right to either buy in the case of a call or to sell in the case of a put, a specific stock at a specific price on or before a specific date. That's all that's happening. Now, if the buyer has purchased the rights, what's the seller done? The seller has sold the rights. If the buyer has the right to do something, what happens to the seller? The seller has become obligated. If State Farm sells me an insurance policy and a 16-year-old hits my truck and messes it up, after I beat the 16-year-old up, I call Jeff and I say, Jeff, you sold me the policy. And Jeff says, I'm obligated to pay it. Dang it. He didn't have a good week. You guys get that? This is not complicated because you're used to doing it in your daily life. It's only weird because we changed the vocabulary from insurance to option. And we went from this thing where we were insuring tangible items to we're insuring intangible shares of a company that you may not have even ever owned. It's the only reason it's weird. Okay? But if somebody sells something, they are obligated to deliver. And you get this idea. So here you see the whole picture. The rights of the option contract go to the buyer. The obligation of that option contract goes to the seller, and they're always a mirror. They're always backwards to each other. What I'm going to share with you on the next slide is what I call the Rosetta Stone of options. If you're familiar with the idea of the Rosetta Stone, all those years ago they had these hieroglyphs and they couldn't read them. And then they found the same text written in 3 different languages, and they knew enough of the languages that they could compare them, and it allowed them to unlock the language, and they were able to kind of decipher, and they called that the Rosetta Stone. That's what this next image is right here. If you will just memorize this grid, you can decipher between the option definition and this grid, you can decipher every option strategy you'll ever get into. You don't have to read the 1,200-page Larry McMillan book. You're welcome to. I don't care. It's a great, great cure for insomnia. Like if you can't sleep at night, just read Larry McMillan. Sorry. He's a great guy. I've never met him. I'm sure he's a great guy. A little bit of a boring book. All right, when you buy a call, you buy the right to buy the stock. When you buy a put, you buy the right to sell the stock. Now, like I said, the seller is always the mirror. It's always the opposite. So ask yourself, what did I do? Did I buy the call or did I buy the put? If I bought the call, I own the right to buy the stock. If I bought the put, I own the right to sell the stock. What if I'm on the other side? If I'm on the other side, I'm selling it. So if the buyer has the right to buy the stock, you as a seller become obligated. Now you're obligated to sell it to them. And with the put option, if you sell the buyer the right to sell the stock, well, if you sold them that right, you become obligated to buy it from them. That's it right there. That is options. That's the function of how options work right there. And if we stopped, all of you who've never understood options before have something you can build on. But why should we stop when I can give you so much more? I mean, if your brain's not mush, did I really deliver? Well, we're going to keep going here. How do these increases and decreases in value work? Well, I'm going to give you kind of a cheat sheet for that too. And it looks like this right here. As the stock goes up, the call option goes up and the put option goes down. As the stock goes down, the call goes down and the put goes up. Take a screenshot, print it off, put it on your computer, put it on the refrigerator, put it on the mirror. It's that simple right there. As the stock goes down, the call goes up, the put goes down. As the stock goes down, the call goes down, the put goes up. Let me explain why. For those of you who are new to options, let's say that you have this trade and it's trading at $325 a share. And let's say that you purchase a call option. What does it do? A call option is the right to buy the stock. So if it's at $325, that means you have the right to buy the stock at $325 a share. Everybody got it? That's what a call is. Now, let's say that the stock is trading at $335. So we have the right to buy at $325. The stock is trading at $335. Really quick. Would you like to buy it at $325 when it's trading at $335? It's $10 a share cheaper. So if any of you have ever traded before and you're like, hey, stock's at $335, I think I should buy it at $335. Bobby comes up, hey, I could buy it at $325. You're like, no, thanks, Bobby. No, I'm going to go ahead and pay the premium $335 over. No way. You're like, $330, you can buy it at $325, man. Get me in on that deal. It's $10 a share cheaper. So, of course, if you have the right to buy at $325 and the stock's trading at $335, of course you're going to buy it for $10 a share cheaper. By the way, that's called intrinsic value. We'll talk about that later tonight. But what if it's the opposite? What if you have the right to buy at $325, but the stock is trading below that price? What if it was this situation where the stock had tanked? If the stock's trading at, in this case, $225, and you have the right to buy it at $325, is there any reason that you would buy for $325 when you can buy it on the open market without your contract for $225? And the answer is only if you have lost your marbles. Ain't no way. So you can see the call option would go up in value when the stock goes up, and it would go down in value as the stock goes down. But what about the put? How's the put work? Well, let's say we had the 325 put. So we're moving from calls to puts now. What is a put? A put is the right to sell. So hypothetically, let's say we have a $325 put. We have the right to sell the stock at 325. Now, what happens if the stock's at 335? If it's at 335, I can sell it on the open market for 335, or I could use my put and sell it for 325. Anybody want to sell at 325 when you can go sell for $10 more? Heck no. But what if the stock went down? What if it was just tanking way below the 325 mark? Would you like to go back and sell at 325? The answer is yeah. That's why a put option goes up when the stock goes down, and a call goes down when the stock goes down. The call goes down because the right to buy is worth less as the stock goes down. The cheaper it goes, the less valuable that contract is. But as the stock goes down, that put, which is the right to sell at a higher price, that's going to keep going higher and higher in value. The more the stock goes down, the more the put's going to go up in value. It's just how it works. Very simple. Now, what if we flip it? If we flip it, you're going to understand why calls go up. So let's hypothetically say that we've purchased a $230 call. A call is the right to buy this stock at $230. And now let's say the stock is trading at $245. Is there an advantage to buying at $230? The answer is yeah. I mean, if the stock's at $245 and I can buy it at $230, that's $15 cheaper. Of course I'm going to do that. And if the stock moves higher and higher, what do you think is going to happen to that $230 right to buy at $230? The answer is it's going to just keep going higher and higher. Absolutely. Now, what if it's a put? If it's a put, the opposite will happen. If it's a put, let's say you had the right to buy at $230, or excuse me, the right to sell. You purchased the put at $230. You had the right to sell the stock at $230. Would you want to sell it at $230 if the stock's going higher? And the answer is no. Stock's going higher. I want to sell it at a higher price. And so when the stock moves higher, that put option goes down in value. And that's how this chart can be deciphered. It's really simple. As the stock goes up, the call goes up, put goes down. As the stock goes down, the call goes down and the put goes up. Now, would you like a cheat sheet? I mean, this is already a cheat sheet, but I'm going to make it even cheatier. I made that up. Just think about it this way. If you think the stock's going up, buy a call option. If you think the stock's going down, buy a put. The end. That's how simple it is. All right, so now you have a little bit more of a foundation of the basics of options. Let me introduce you to option chains. What are option chains? Well, option chains are simply a spreadsheet with all the details that you could want about your options. That's all it is. Just a spreadsheet. Sounds boring, right? And it is, but it's very useful and very important. It's all the pricing data. It's all the additional relevant information connected to your option chain. Now, I'm going to share one with you. If you've never seen one before, I'm going to warn you, there's a good chance that this is going to break your eyeballs. Literally, when you see this, you're just going to go, and, since Halloween's in a couple days, it's probably appropriate. So here we go. Ready? There it is. Scary. Whew. All those numbers. What could they possibly mean? Well, here's a scarier version. Oh, man, lots and lots of numbers. It's just like a blur when you see it, right? Until you understand it. And once you understand it, it's not that bad. It's really not that bad. So let me help you break it down here. On the left, you have the calls. On the right, you have the puts. So over on the left, everything you see on the left is calls. Everything you see on the right is puts. How do you know that? Because at the top, it says calls and puts. See, that was easy. The top, it says calls. On the right, it says puts. Everything is calls on the left. Everything on the right is puts. Now, you say left and right of what? Those numbers in the middle are the strike price. And if you're not familiar with that language, I'll define it for you. The strike price is the price at which you can buy or sell. It's not the price of the option. It's the price, the value of that contract. It's not even the value of the contract. It's the details of the contract. You have the right to buy at the strike price, or you have the right to sell at the strike price. It's just a contract. Okay? Now let's go on the call side, and we'll look at the far left. You see the last column that's called literally last. And what last column represents is the last price that the option traded. Not the current price, the last price an actual option traded for that strike price. So you see the strike price is down the middle. So you go to the 378. kind of where my cursor is, if you can see that. You go all the way to the left, you say, well, that last traded at $1.79. You go to the next column and you see what we call the bid column. And you see the price for the bid happens to be $1.79. It doesn't always line up, but in this case it does. Here's an example. Go to the 374 at the top. See that 374 strike price? If you go to the far left, you see the last price was 505, but you see the bid was 498. So just because the bid and the ask, in this case the ask was 508, they don't always align with the last price. The last price is the last price it was traded. The bid is the quote price at which you can sell. Saying, hey, who would, somebody's out there saying, I'll bid this for $1.79. I'll pay $1.79. Will you sell it at $1.79? You can either agree to it or you don't have to. It's no big deal. But if you put a market order in, you'll get filled pretty close to the bid price. The next column is the ask price, and this is the quote price at which you can buy. Okay, so if the ask is 182, then a market order is probably going to get filled pretty close to 182. The difference in those two numbers, 179 to 182, or the difference between the bid and the ask, is known as the bid-ask spread. The words there are bid, B-I-D, and ask, A-A-S-K. And I know some of you heard something different, but that's not what I said. It's bid-ask spread. All right, now you understand how to read the call side. What about the put side? It's exactly the same. You got a bid column, you got an ask column, and you got a last. Exactly the same. Now you understand option chains, right? If you go to the more complex option chain, which I'm not going to get into, but it's exactly the same. Calls on the left, puts are on the right. Every column, the strikes will be right in the middle, and every column is just going to give you more information and more details about those options. That's all it is, okay? Now let's talk about the standards that are associated with stock options. What do I mean by standards? Well, in the world of trading, we need standards. It's what keeps the world going. It's what keeps everybody sane. Otherwise, you just get all these random numbers and random things happening with, in this case, your options. And so in the case of options, those standards are set by the Chicago Board of Trade. So the Chicago Board of Trade is responsible for setting and establishing the standards for stock options. Now, what does that do? It avoids weird things. For example, somebody here might have purchased 109 shares of Apple at $101.33. And they think, I want to sell somebody the right to buy Apple at $101.33. And it's 109 shares. Well, that's just weird. It's odd. And it's too obscure for it to really make a clean market that's easy to trade. So what the Chicago Board of Trade does, what the standards do, is it creates standardization between the contracts so that we have a uniform and a liquid market. Okay? That way, whenever you sign up with your broker and you sign your contractual agreements and you say, yep, I want to trade options, and they say, well, do you agree with all these disclosures and you agree with all this stuff? And you say yes. When you make those agreements with your broker, you're literally signing your name and saying, I agree to the standard option contracts. Whenever I trade an option, this is basically that contract. It's like you signed every one of those future contracts that you're going to trade. Okay. So what are the standards? Well, contract sizes. That's the first and most obvious one. Strike prices. So we don't have the 101.09 as a strike price, but rather we have a nice standard number for strike prices. And then expiration dates. These are the standards that the Chicago Board of Trade establishes for every option contract. So let me hit them really quickly. Every option is always going to trade in contracts. As I said, it's a legal document. When you trade an option, you're not trading equity in a company. There's no ownership involved. You're trading a legal document called a contract. It is an actual contract. Those contracts are always written in increments of 100 shares. So if you want to trade 100 shares in an option, you trade one contract. One contract is 100 shares. If you want to trade 200 shares, you're going to trade two contracts because every contract is written in increments of 100 shares. Now, here's where it gets a little confusing, but only for about the first 5 minutes. Once you learn to do it, it takes zero time. Those option contracts are not priced as a contract, they're priced per share. So every contract is worth 100 shares, but they're priced as a per share. So for example, when you look at this example right here and you say, okay, these calls, this one's the last time it traded was at 251 per share. Well, there's 100 shares, so that's $251. It's easy math. You add two zeros. And, I've heard people say, well, you should price it in contracts. No, we shouldn't. We price it per share so you can see relative to the stock. This stock, the 377, that's $377 per share. Can you imagine if we said, well, to buy this contract, it's $251. Is that per share? How does that work out? It just makes more sense to make it per share rather than per contract. Okay, so that's why we do it that way. All right, so the first standard is the number of shares, 100 shares per contract. Next, we talk about strike prices. The strike price is the price at which you have the right to buy or sell the underlying stock. You do not pay that price. It's the details of the contract. That's all it is. Strike prices over the last 20 plus years have changed a lot. When I started trading in 1999, we had very strict standards and they were really, really specific. They have changed. Back then, if a stock was trading over $25, if it was under $25, it would have had a $2.50 increment. If it was over $25, you would trade in $5 increments. And if you got over $200, it would move to $10 increments. And that's technically still the standard. But over the years, what they've done is they've issued additional strike prices. So now almost every stock you're going to trade, not everyone, but almost everyone, will have $1 increments. So you'll have have the opportunity to buy at 100. You have the opportunity for 101 as a strike price, and 102 and 103. So that's where we are today. Okay, but the standards are still there, and I put it here so you have a reference. This is the actual standard. You rarely see it today. Sometimes you do, but rarely do you actually see these limitations. The standard says stocks that are less than $5 don't trade options. The standard says if a stock is trading between 5 and 25, strike prices are in 250 increments. So it's 5, 750, 10, 1250, etc. The standard says between 25 and 200, it's $5 increments. So you have a 25, 30, 35, 40, and on and on. The standards say if it's over 200, you trade in $10 increments. But I'm telling you, you rarely see that anymore. And what's funny now is when I'm working with somebody and they actually see this, they're like, where'd all the strike prices go? Why is it $5 increments? I'm like, because this one doesn't have anything else. You can trade whatever strike prices are there. I just want you to know what the standards are. Okay. Now let's talk about expiration day. Expiration day is the day on which the option expires. If we think about this in terms of insurance, insurance is going to have a term. Usually like a 6-month term or maybe a year. You can also do like a 1-month term. But for the most part, most insurance policies are going to be 6 months for your standard, like homeowners or automobile. Be like 6 months, and you'll either pay all 6 months up front or you'll pay a monthly premium. That is the 6 months divided by 6. Okay? That is your typical standard term for your insurance. Stock options are the same. Stock options have we'll call it a term. It's a time frame that is relevant. And once we get to the end of that term, which we call expiration day, that option is no longer relevant. It either has value or it doesn't have value. And it expires. Okay? The standard expiration is the third Friday of the month. So if you look at your calendar and if the first day of the week or the first day of the month is on a Friday, you'll have, whatever month that is, October 1st, Friday. Count 3 Fridays. One more Friday would be October 7th. One more Friday would be the 14th. That's going to be the third Friday of the month. If the first Friday of the month is the 10th, which it wouldn't be, but if it was the 6th, whatever day it is, then you're going to count out and you see 1, 2, 3. That's the third Friday of the month. That is the standard monthly expiration for your option. And until more recent times, those were the only expirations. When I started trading, we only had monthly options. When I started trading, we every time we would just sit there and we'd count out, okay, what's the third Friday of the month? Then along came weekly options, and now we've got all sorts of expirations. Weekly options expire on the Friday of the week they expire, and they usually get issued 6 weeks in advance. So as you get closer and closer to expiration, you'll start to see weekly options coming on board. So you go further and further out, you'll see monthly options, and then you go far enough out, you'll see quarterly. And they issue those by the quarter. So if you were to go look at, something that's 12 months down the road, you're not going to have weekly options 12 months from now. If you go look at option expirations that are 12 months from now, you're looking at probably a quarterly, like maybe it's December, and then you look at the next one and it will be March. You're like, where's all the other options? Well, we haven't got there yet. They haven't issued them. Okay, so they issue quarterly. As you get closer, they start issuing monthly. As you get within the last 6 weeks, they start issuing weekly options. But not all stocks trade weekly options. So just remember that. Not all stocks have weekly options. Couple of notable exceptions. SPY. If you trade ticker symbol SPY, and now they're doing it for QQQ as well, they actually have an option that expires on Monday. They have an option that expires on Wednesday, and they have an option that expires on Friday. So that is one exception. If you are trading European style, for example, straight VIX options trade European style, they expire on Wednesday. Why? Because they're European. I can't explain them. They're Europeans. If they were American, they'd do it on Friday. But they're Europeans. Nobody knows. All right, those are the exceptions you need to know for now. Finally, what I want to talk about is option pricing. And option pricing, again, I could spend hours talking about this. We're not going to go get into the Greeks, and we're not going to get into the details of, all kinds of pricing. I'm going to teach you high-level, general understanding of option pricing. And then later, if you want to go deeper, you can look at a deeper course. But what you need to know about option pricing is it's confusing at first. And frankly, it's probably one of the more confusing things of options. Let's just be honest. Yeah, option pricing is confusing. But it doesn't have to be. You don't have to sit here and be like, oh, I got to know every detail. You really don't. You only need to know a couple details. I'm going to tell them to you right now. So when you look at an option like this one here, this is a 378 call. That means you have the right to buy this stock at 378. What's the 179? What's the 182? That's the price of the option. You say, well, what's the 378? That's your strike price. That's it. So imagine, let's say you have a $500,000 house and you insure your house with whoever, State Farm, and you have a monthly premium and you insure your house for $500,000. If the house burns down, they got to replace a $500,000 house. That $500,000 would be your strike price. That's the value. But you don't pay $500,000 for your insurance. You're going to pay a few $100s a month. Maybe it's 120. Maybe it's 110. I don't know. So $110 a month buys you an insurance policy that insures your house at $500. What if you had a deductible of, say, $10,000? Your house would be insured at $490. The other $10 would be part of your deductible. So you pay your premium, and now you can get up to $490,000 for this house that's worth $500. The strike price in that example would be $490. Now, if you had a strike price or a deductible of $10,000 versus zero, Do you think your premium would be higher? Zero is probably going to have a higher premium because there's no deductible. What if you had a big deductible? What if you have like a $50,000 deductible? I have a $500,000 house. I have a $50,000 deductible. So it's insured at $450 even though it's worth $500. Well, that premium, instead of being like $120 or $130 a month, it might only be $85. Why? Because they're insuring a smaller percentage. The same is true with your options. So understand this. The strike price is simply the price at which you have the right to buy or sell the stock. Consider it the value of your contract, the value of the thing that's being insured, right? In order to get that right, you have to pay an option price or a premium. What do we call it in insurance? We actually call it a premium. That's exactly what we call it in insurance as well. Same thing is true with options. So how do we determine the option premium price? Well, this is where it gets a little complicated. There's two big parts that we use. Number one is what we call intrinsic value, and number two is what we call time value. Intrinsic value plus time value equals the price of the option. Let's break them down. Intrinsic value is the built-in value of the option. It's going to either increase or decrease based on movement of the underlying stock, and it is not impacted by time. That make any sense to you? It made perfect sense to me, but I can see if it wouldn't make sense to you guys. Let's say it a little bit differently here. If you have a $500,000 house and you insure it for $550,000, you're insuring it for $50,000 more than it's worth. That would be intrinsic value. You're building in more value than it's worth. Makes sense? If you insure it for less, then you're not insuring the entire value. So you're not getting any built-in value. In the world of stock options, that's one of the things that's different. Your insurance company wouldn't do that, by the way. But with the world of stock options, you can buy an option that has a bunch of intrinsic value. It's already got value built in. It's not, the term is in the money. It's not out of the money. It's built in. It's got intrinsic value. It's one of the unique things you can do with options. And option buyers want intrinsic value. When you have an option that's in the money, it's got intrinsic value. Option sellers, on the other hand, do not want intrinsic value. Option sellers want the intrinsic value to be gone, and they want it to disappear. They don't want any value in that option when it's done. So intrinsic means that it's built into the option. There's value built into it. Now, here's what you need to know about that. At expiration, the only value that remains in the option is intrinsic value. So if you have an option that has intrinsic value and you get to expiration, it will still be worth the intrinsic value. It will always be worth at least the intrinsic value. It's built in. That's why it's valuable to an option buyer and not valuable to an option seller. Here's the formula. If you're looking at a call, it's the current stock price minus the strike price is going to give you the intrinsic value. Current stock price minus the strike price. If you're looking at a put, it's the opposite. It's the strike price minus the current stock price will give you the intrinsic value. It's just the difference in the two. Okay? Now, what you need to know is intrinsic value cannot be less than zero. Cannot be less than zero. So let's do some examples here. And what I want to do is let's come over to our charts and let's actually go to an options chain. And this is for, let's do SPY. And I'm going to give you the numbers right here. So if you can see this on the chart, The current value is $687.39. That's the current price of the stock. If I go to my call options, which are on the left side of the option chain, and I come down to a 685 call, what does that give me? Well, 685 call gives me the right to buy at 685. How much is that going to cost me? So glad you asked. I'm going to come to my bid and my ask price, and I'm going to say it's going to be about $4.70 a share. So my premium is $4.70. Now the next question, is there any intrinsic value? Well, if I have the right to buy at $6.85 and the current stock price is $6.87, what's the difference in the current stock price and $6.85? And the answer is about exactly $2.39. That, ladies and gentlemen, is intrinsic value. The $2.34 is built in. Now, if you come to your premium and you say $4.70 is the price of my option, but $2.34 is the built-in value, the difference is what you're about to learn about, and we call that time value. Let's do some more examples. Stock price is still $687.39. It will remain that price because the market's closed. What if I have the right to buy at $690? $690 call. Great. So I got the right to buy at $690, but I can buy it on the open market for $687. Well, if I were to subtract the difference, I would get a negative number. It can't be negative, so I have zero intrinsic value. And if I look at my premium is $1.98. That means that this is 100% time value because there's zero intrinsic value. My premium is $1.98. The end. But I have the right to buy the stock at $690. Now, if you're overly analytical, you might be thinking, well, why would someone do that? Why would somebody want the right to buy at $690 if it's trading at $687? The answer is you don't care. It actually doesn't matter. It doesn't matter why they would do it. I'll answer it. They might be ensuring a short trade. They might be speculating. There's all sorts of reasons why. Don't sign up for that class because you're never going to get the answer you want. Just know if the option is here to be traded, you can trade it. And in the case of the 690, you can look at the open interest and say, well, there's 45,000 contracts. So clearly somebody's trading that. Let's do a put example here. Okay, still same price here, $687.39. And let's say that we are coming over to our puts. The puts are the right to sell. And let's say that we have the right to sell at $690. Well, $690 is more than $687.39. So the difference in those two, well, crud, now I have to do real math here. Let's see, what would that be? 61 cents. 261, I think. That was hard math for me. So you say, well, that's 261 is your intrinsic value. What's the price? The last price was $5.15. The current ask is $5.11. Of that $5.11, that's your option premium. $2.61 of that is built in. It's intrinsic value. And the remaining portion is time. Make sense? If it doesn't make sense now, that's all right. Eventually, I think it will. This is a very important thing in terms of option pricing because if you look at the way this option chain goes, you can see the higher the price, the more expensive the put options get. Why? Because they have more intrinsic value. And the lower the price, the cheaper the put options get. But when you look at the calls, it's the opposite. With the calls, the cheaper the stock price, the more expensive the option premiums. And the higher the stock price, the cheaper the option premiums. And then you're going to notice on this option chain, all option chains are a little bit different, but this one, as is the case with many, you notice that it's dark gray and then it's lighter gray. That is the line right there where it changes from having intrinsic value to having no intrinsic value. And we got a term for that. And it's a term that I'm going to teach you in just a minute, but for now I'm going to teach you about time value. So remember, there's two values that add up to create the option price. Intrinsic, the built-in value, plus time value. Now, time value is constantly disappearing. This is where the premium comes in. If you were to liken this to insurance, insurance sells no intrinsic value. You know, you're buying intrinsic value for your homeowners. It's all premium. It's all time value. Okay? So the premium is the amount above and beyond the intrinsic value that you have to pay for this right to buy or the right to sell. It is above and beyond the intrinsic value. And it gets lower and lower the closer you get to expiration. That's what you need to know. An option that has a week to expiration will have much lower premium than an option that has a month to expiration. And an option with a month will have less premium than an option that has a year. Why? Because it's less time. Your homeowner's insurance, if you buy a month's policy, it's going to cost you maybe $150. If you buy it for 6 months, it's probably about $800. If you buy it for 12 months, it's probably about $1,600. Because the longer the term, the longer the policy, the more expensive it's going to be. Pretty simple, right? Options are the same way. So here's the formula. Take your option price, subtract the intrinsic value, you're left with time value. And that's what I did for you just a moment ago. Whenever we looked at this and we said, okay, if we have a 690 put and the current price is 687, 690 minus 687.39 is, what do we say it was? 261. So 261 is the intrinsic value. Now we take a look at the option price. If the option price is roughly $5, because I don't want to do $4.99, we're going to say $5 for the option price. Take out the 261, and what you're left with is 239. 239 is the time value or the premium that you pay for the right to buy at 690. Now, why would we do that? And the answer is because it's in the money. It's deep. It's got intrinsic value to it. You're already prepaying for $2.51, whatever it was, 261 of money, of value. I already have the right to sell at 690 and it's already down to 687.39. I can sell this sucker for $2.61 like that. Absolutely. That's intrinsic value. It's built in. Starting to make a little bit more sense? I hope it is. All right. Let's talk about in the money, out of the money, and at the money. This is just some basic option vocabulary for you to mull over. In the money means it has intrinsic value. Out of the money means it doesn't. And at the money is exactly what it says. It's right in the middle. So in the money, the option does have intrinsic value. If it has intrinsic value, it's in the money. If it's out of the money, it does not have intrinsic value. And what we call at the money is the option strike price that's closest to the actual price of the stock in that moment. It's the option strike closest to the price of the stock. Now, this is really easy when you look at your option chain. If your option chain is shaded like this one, the ones that are shaded are in the money. They have intrinsic value. The ones that are not shaded are out of the money. They do not have intrinsic value. Now, in this particular option chain, this is the one that's built into the software that we built. We have highlighted at the money. And this is where it cuts off. So 687.39 makes 687 call slightly in the money and a 687 put slightly out of the money. 688 put is slightly in the money and a 688 call is slightly out of the money. That is at the money. That is called at the money. These are at the money options. On the call, in the case of the call, the lower the stock price, the more in the money. In the case of the put, the higher the strike price, the more in the money. In the case of the call, the higher the strike price, the more out of the money. And in the case of the put, the lower the strike price, the more out of the money. It is important that you understand this because as we get further into the retirement wheel, there will be many cases where we talk about sell or buy, but selling out of the money or selling at the money. In the case of option selling, you will probably never hear me to tell you to sell in the money. There's a few rare cases where I would, but for the most part, when you're selling options, we're going to sell out of the money. When we're buying options, we usually do the opposite. We usually buy in the money. So depending on where you are with your options journey, you may be more or less comfortable with this terminology. But for option selling, for the retirement wheel, we're primarily going to be selling at the money or out of the money. Very rarely would we do anything different than that. All right, ladies and gentlemen, let me give you some homework, and then I'll open it up and answer any questions you might have. It's really simple. For this first lesson, review as needed. Ask any questions as needed. If you need to send an email, feel free to do so. Send it to help@trademaestro.com, help@trademaestro.com. And next week, we're going to start in with our option selling and actually moving into the more advanced strategy of the retirement wheel. Well, there you go, folks. I hope you enjoyed that. I hope you got a lot out of it. Let me know what you think in the comments. If you got any questions, please leave them down below. I'll do my best to try to answer them for you. And of course, if you're interested in learning about the Retirement Wheel Accelerator, then check out that as well. I've put that down below, and I would love to have you join us for that. But if you just want to learn more about options, check us out over at TradeMaestro.com, TradeMaestro.com. And until next time, I wish you the best. Be sure to like and subscribe. Like and subscribe. It's the only way you get the notifications, and it really helps us out, okay? Until next time, happy trading to all of you. We'll talk to you soon.